Hello, and welcome to the latest Insights Live tax strategies for today and tomorrow. I'm Susie Allen, Vice President of Insights from Fidelity Wealth Management. Thank you for joining us today and submitting questions. Your questions have helped shape our discussion. So today we're talking taxes, a very important planning topic here. And taxes have been in the headlines recently with policy changes, and we know many of our clients are wondering about strategies to help reduce taxable income, pass on more wealth, and lots more. So we have a lot to cover today, a little bit of a roadmap. First, we're going to talk about the latest tax laws and what they mean for you. Then we'll move the conversation to Roth conversions, managing taxes in retirement, and estate planning. And we'll end our conversation with a discussion on taxes on investments. But before we get going, a few disclosures. Fidelity does not give tax or legal advice, and nothing we discuss today should be interpreted as tax or legal advice. The information we are providing is going to be educational in nature, and it may not apply to your situation. If you do have legal or tax questions about your specific situation, we encourage you to talk to your attorney or tax professional. So let's get started. First, I'd like to introduce my colleagues from Fidelity and our special guest from Ernst & Young, a leading tax firm, who are here with us today. I'll ask them to introduce themselves and briefly describe their role. So Seema, let's start with you.
Yeah, thank you so much for having me. As Susie said, my name is Seema, and I'm a Vice President Wealth Planner in the Sarasota Investor Office. I help clients and their families align their financial and personal goals into an action plan that we revisit each year. I'm a certified financial planner and a chartered financial consultant.
Welcome, Seema. Julie.
Yes, thank you for having me. So I'm a former estate planning attorney. I'm still licensed and in good standing in the state of Florida. I'm also a certified financial planner. And in my role as an advanced planner with Fidelity, I help clients tie their financial plan in with their estate plan.
All right, welcome, Julie. And Bobby.
Thanks for having me on today, Susie. Very excited to be here to talk everyone's favorite topic, taxes. I'm part of the private client group here at EY. We support individuals with how they can optimize their tax situation and how it fits into their overall financial plan.
Well, welcome, Bobby. Welcome, panelists. So let's start with the big changes that have made headlines earlier this summer, the new tax bill. Bobby, can you give us a high-level overview of the key changes that are likely to affect our clients?
Sure, happy to, Susie. I think, first, it was very nice of Congress to pass this on the 4th of July this year, made for some very exciting reading on the beach. Maybe not the ideal reading on the beach, but nonetheless. So let's start with some of the provisions that stayed the same. There were many provisions from the Tax Cuts and Jobs Act of 2017 that were set to expire. This new legislation made those permanent. So what are those? The current tax brackets stayed the same. So the top rate stays at 37%, where previously it was set to sunset back to 39.6%. The state and local tax deduction, which is often referred to as SALT, which was a big sticking point in the negotiations, was increased from $10,000 to $40,000. Now, there are some phase outs and limits on timing, i.e. it's not permanent, but we'll touch on that in a little bit. The estate tax. So there's a lot of uncertainty around the estate tax and around multi-generational wealth planning in the past, given the lifetime exemption was not permanent and some of the sunsets that were set to occur. The recent legislation makes the lifetime exemption permanent at $15 million per individual. Now that'll be indexed for inflation. But I think this is a big one that'll allow folks more certainty as they're thinking through their wealth transition planning. The qualified business income deduction for business owners out there was made permanent, which provides a 20% deduction for their qualified business income. And for some higher income filers, there's going to be some new limitations starting in 2026 on the deductibility of their itemized deductions and charitable contributions. Seema is going to touch on that a little bit more later on.
Well, thank you for highlighting some of the big changes. What about some of the lesser known changes clients should also know about?
Yeah. So we heard a lot on the campaign trail about things like no tax on tips, no tax on overtime, no tax on Social Security, deductible car loan interest. So what actually happened with some of that stuff. No tax on tips and overtime. So that is now law, and it allows a deduction of up to $25,000 for married couples. Now there are some phase outs to keep in mind that start at around 150 and $300, 300,000 depending on filing status. Deductible car loan interest, which allows a deduction now for up to $10,000 on car loan interest for cars assembled in the US. Again, there are some phase outs to be mindful of with that. Now, one thing that was talked about a lot that's not in the final legislation was tax on Social Security. So everything related to taxation of Social Security remains the same under the rules that it always has been. Then probably worth mentioning, there's a new savings account for kids called a Trump account, which is fundable with up to $5,000 a year. It's treated very similarly to a non-deductible IRA contribution that parents and others can contribute for kids up until age 18, at which point it effectively converts to a traditional IRA.
Thank you for running through some of the bigger changes and lesser known, lots to unpack. Let's start with some of the immediate considerations for income tax planning. You mentioned the SALT caps. Can you explain a bit more what that means for higher income tax filers?
Yep. Yeah. So the SALT cap refers to the state and local tax deduction, and this was limited under the Tax Cuts and Jobs Act to $10,000, which presented a big change and challenge for some folks, especially in high tax states, and homeowners, that were paying taxes in excess of $10,000 that were now unable to deduct the full amount. So under the current legislation, the bill that passed, this year, that was expanded to $40,000. So we go from 10,000 to 40,000, but there's a couple things to keep in mind with that. That's not permanent. So we have that through tax year 2029, and it's set to increase 1% a year through 2029. And then when it comes to phase outs, for folks that earn more than $500,000, they can only take advantage of a reduced deduction, and it gets phased out entirely once you hit $600,000 of income.
Thank you for running through those. Lots to consider. Now, let's talk a little bit about charitable deductions. What about changes there? Seema, can you speak to this from a high net worth perspective?
Sure. So starting in 2026, there's going to be changes for deductions for charitable giving. For starters, if you do not itemize, which actually is a majority of filers, you will be able to deduct $1,000 for single filers and $2,000 for married filing jointly for cash contributions. For those who do itemize, the new legislation will cap tax benefits of charitable deductions at 35% of adjusted gross income, even for those in the 37% marginal tax bracket. That means those in our highest tax bracket will lose 2% of their deduction. And you can only claim a tax deduction to the extent that your qualified contribution exceeds 0.5% of your adjusted gross income. Finally, the new law permanently extended the ceiling on deductions of up to 60% of adjusted gross income for cash contributions to most public charities. Because of the floor and the cap for itemized deductions, charitable bunching may make more sense for a lot of charitable givers this year. Charitable bunching is taking several years' worth of donations and giving it in 1 year either to the charity itself or to a donor-advised sponsor. A donor-advised fund is like a charitable investment account that allows for irrevocable, tax-deductible contributions upfront while making grants to charities now or over time.
All right, thank you, Seema. Let's bring Julie into this conversation a bit more. So, what do the new federal and gift estate tax rates mean for clients?
Yeah, so first of all, let's go back over those exemption amounts. So for 2025, the estate, gift, and generation skipping transfer tax exemptions are $13.99 million per taxpayer. And then in 2026, this is going to increase to $15 million per taxpayer. And then that $15 million exemption is going to be indexed with inflation in future years. And then we also have the annual gift tax exclusion. So this is the amount you can give away each year to anyone, and it's not even considered a taxable gift. And so this wasn't changed by the new tax law. That amount for 2025 is $19,000 per recipient. And then this amount is indexed with inflation, and it can only be increased by $1,000 increments. And so it's likely it will increase to $20,000 at some point in the next few years. So with these higher exemptions, the reality is that most taxpayers won't have a taxable estate at the federal level. But the other reality is when it comes to tax laws, permanent, unfortunately, doesn't really mean permanent. So in other words, a new administration and Congress could make changes to the One Big Beautiful Bill Act and then lower the exemptions, which would make more taxpayers subject to federal estate taxes. So of course, it's going to be important to monitor changes in the federal tax laws as we go forward. But going back to your question, Susie, so for now, what does that increased exemption mean for our clients with states that are valued above the exemption? I'm sorry, below the exemption. So for those clients, while your estate won't be taxable at the federal level, depending on the state where you live or where you own real estate, your estate may be subject to some taxes at the state level. And so there's still a handful of states that collect a gift tax. So I'm looking at you, Connecticut. And then there's an estate tax or an inheritance tax, or maybe even both in other states. And I'm looking at you, Maryland, you have both. And so, for example, while the current exemption is that 13.99 million, in Oregon, the state exemption is only 1 million, and in Massachusetts, it's only 2 million. And so you need to be aware of these lower state exemptions and then plan accordingly. And then what does it mean for our clients who have estates that are already valued over that higher exemption? So for those of you who haven't already maxed out your lifetime gift tax exemption, now's a really good time to start planning your estate taxes. So the sooner you start, the potential for reducing those estate taxes is greater. And then if you've already maxed out your lifetime gift tax exemption, then the good news is you'll be able to continue to gift as the lifetime exemption increases. So for instance, in 2026, when that exemption goes from 13.99 million to 15 million, you'll have an additional 1.01 million to gift. And then of course, for everyone, you'll still be able to make those annual exclusion gifts, which is up to $19,000 in 2025. Those aren't considered gifts at all.
Well, that's great. And I appreciate the state by state reflection point there. So just make sure that you're familiar with what's happening in the different states. All right. Well, given the new estate tax limits, what does that mean for estate planning from a tax perspective?
Well, so some practical tips that you should consider taking now would be to review your current and projected net worth with your financial advisor. So while your estate might not be taxable now, you may be surprised to learn that based on that projected income and expenses and then the growth on your portfolio, you may have a taxable estate in the near future. And so planning now could reduce or eliminate those taxes. And so this has happened with several clients I've met with since the new law was passed. So while they thought they were safe from estate taxes with the higher exemption, the reality is that the growth on their portfolio is projected to outpace the inflation-adjusted exemption. And so their estates are projected to become taxable in the next 5 to 10 years. So definitely something to take a look at now so you can plan for a potential taxable estate. And then you should also review your foundational estate planning documents, and you want to focus on the tax provisions. So estate planning has really shifted over the past few years to encompass both estate tax planning and income tax planning. So before the focus was mainly on the estate tax planning when the exemption was much lower, but now we're also incorporating income tax planning into estate planning. And so you want to make sure your documents incorporate flexibility for income tax and estate tax planning, and that the documents will allow for modifications as the laws change. And if you have any existing irrevocable trusts, then you want to review those for any type of estate or income tax planning opportunities. So typically, irrevocable trusts are drafted to address changes in tax laws. So you want to review them to see if there's any steps you need to take now to take advantage of the higher exemption, or maybe make some adjustments to minimize income taxes. And then for those of you who have a taxable estate who have done little or no estate tax planning, of course, now's the time to explore those estate tax planning trusts and other strategies that could potentially minimize your estate taxes. So I'll go into more detail about this type of planning later on in the webinar.
Thank you, Julian. I know trusts are an important topic to our clients, so we'll circle back there for sure. So, Bobby, are there other strategies clients may want to consider to reduce their tax bills this year and going forward?
Yeah, Susie, I think this time of year and really all throughout the year, I think tax bracket management is very important. It's critical to consider, the implications of the tax brackets, understanding where you are, where you may be heading going into year end. Things like bonuses, retirement plan distributions, selling investments, charity. These are all things that play into what tax bracket you find yourself in, and having an understanding of where you're projected to land, and if there are things you can do to, control the narrative and things as you go towards year end. Could you potentially defer some things and or accelerate to achieve a better tax answer from a bracket perspective? For example, you have control over charitable giving or timing of selling investments, gains and losses. Roth conversions can also be an interesting tool. One thing that's become more commonplace over the last few years is fewer folks itemizing their deductions, as Seema pointed out, given the increased standard deduction, which is currently a little under 16,000 for single and a little over 31,000 for married folks. So I think very important to think about your charitable giving, and if bunching your contributions into one year might provide more benefit, given you may be able to itemize in that year that you bunch into. And as Seema pointed out, the use of a donor advised fund can be a very important tool to consider when you're thinking through this type of planning. I think going forward, I think considering maxing out your tax advantage accounts, such as your 401ks and your 403bs and your health savings accounts, since everything you contribute to these accounts is typically with pre-tax money, which lowers your taxable income.
And a follow-up question for you. Are there any special considerations for business owners?
Yeah, I think there are three things that are top of mind when it comes to business owners, especially given, in light of the recent legislation. So one, the qualified business income tax deduction, which we had talked about a little bit earlier, is made permanent. So are there opportunities to structure things to be as tax efficient as possible? Choosing the type of entity, how you operate, how things are paid, how they're structured, I think are all critically important for business owners now. Number two would be bonus depreciation, which is now permanent. And so bonus depreciation is the ability to immediately expense certain purchases of assets used in your business. And the new law states all eligible purchases after January 19th, 2025, when the bill was initially introduced into Congress, now qualify for 100% bonus depreciation. Few things to keep in mind there. You'd want to work through with your tax advisor, but there's certain rules around different types of losses and how you can deduct them, the timing of when you capture that benefit, including excess business loss, passive activity loss rules, and certain, as Julie pointed out on the estate tax side, certain state level implications you'd want to think through as you're considering bonus depreciation and accelerated depreciation, as each state has different rules. Then the last thing for business owners, I would say, is the pass-through entity tax, or the entity, paying your state level taxes at the entity level. There was a lot of concern that this was going to go away in the recent legislation. It didn't, and so for business owners, there's still an ability to deduct your state level taxes at the entity level. And I think the takeaway there is that it's not impacted by the $10,000 or $40,000 state and local tax cap that we talked about earlier.
Thank you, Bobby. Great considerations. Let's switch gears a little bit and talk about longer term tax planning strategies. So we received many questions about Roth conversions. Seema, can you walk us through some of the considerations around this decision?
Absolutely. So you're right. I do get a lot of questions on Roth conversions. So I want to start with just a few advantages that Roth IRAs have over traditional IRAs, which include no taxes on qualified withdrawals, no required minimum distributions, and the potential for tax diversification. So if you think you're going to be in a higher tax bracket in the future or have more required minimum distributions than you need for your living expenses, or you may want to pay taxes on behalf of your heirs, you may want to consider converting. Future tax rates can be really hard to predict. However, by paying your taxes now, you can avoid potentially higher tax brackets in the future if there are tax law changes or any other events that could potentially increase tax brackets later in life. A Roth conversion is also a really great way to leave a more tax efficient legacy for heirs. So for example, if you leave behind a traditional IRA asset to a non-spouse, Required minimum distributions are required to be paid out within 10 years at the heir's income tax rate, whereas Roth IRA assets are tax exempt and usually delayed until the 10th year so that tax exempt growth can continue. Oftentimes, the heir is actually receiving the inheritance at their own prime income earning years. And because distributions are required over 10 years, in combination with their own income, it could potentially push the inheritor several tax brackets higher than the owner of the IRA. So by paying taxes at their own rate, the individual may potentially reduce that tax burden for their heir. There are a few considerations, though, with regard to Roth conversions. So it's just really important to keep in mind that any converted assets included in a Roth conversion will be treated as income for the current tax year, which will increase your adjusted gross income. So you just need to consider how you will cover that tax bill. In addition to that, any individual that's 63 and older has to be mindful of how it may impact future Medicare premiums. So if your income is above a specific limit, the federal government adds an extra charge to your monthly premium. This charge is known as the Income-Related Monthly Adjustment Amount, or commonly referred to as IRMA. There's a 2-year look-back period for IRMA, meaning it's based on your income from the 2 years prior. There's another thing to keep in mind, which is called your net investment income tax, or NIT for short. Roth conversions are also added as income when you're calculating your modified adjusted gross income. So for individuals that are single filers with a modified adjusted gross income above $200,000 or $250,000 for married filing joint, there's an additional 3.8% taxed on top of your capital gains rate. Given the considerations I've outlined, I think it's important to really consider Roth conversions before you reach RMD age. The other thing to consider is if you know your tax bracket will significantly fall in any one given year, it may present an opportunity to do a conversion.
Thank you, Seema. I know we give you lots of acronyms to talk through there too, and a lot of great considerations, so I appreciate it. Wondering what are other strategies available to help manage taxes on retirement income?
Yeah, so as Bobby mentioned, we talked about tax bracket management. So to take it a little bit further, when a client reaches their required minimum distribution age, their required withdrawals may impact their tax bracket. So if you have a majority of your assets in pre-tax dollars in accounts like your IRA or your 401k, you may want to consider what's called an accelerated distribution schedule. So under this approach, an individual would actually take more money than they need out of their IRA for the year, but not so much it pushes them into a higher tax bracket. They can then move those assets into either a taxable registration or even a Roth account, and this will help give them tax diversification and smooth out their tax brackets over their lifetime. Another strategy someone might want to consider is in their low bracket tax years, they could do what's called capital gains harvesting. So if a client finds themselves in a 12% or lower tax bracket, there's an opportunity to harvest gains since the tax rate on any capital gains would be 0 for someone who's in a 12% or lower tax bracket. Further, if the individual actually doesn't need those funds, they could repurchase the same assets and reset their cost basis. Remember, it's fine to repurchase those assets immediately since there's no wash sales on gains, only for losses. And then one final strategy I just want to discuss is purchasing a qualified income annuity. There was a tax law change a few years ago that made it possible to satisfy your RMDs with income purchased from pre-tax qualified dollars from an IRA. In some cases, it may actually reduce or eliminate the RMD on that IRA, which can actually help manage your income as well as continue to grow your assets tax deferred. So the additional part of that is you can actually use any excess cash from the annuity payout to determine your RMD from other qualified accounts. I know I talked through a lot there, so just remember it's always important to consult a tax advisor before you implement any strategy.
Well, these are certainly great strategies, Seema. Thank you. Wanted to bring in a question that we received from a client, and I'll paraphrase a bit here. So can you talk about withdrawal strategies for retirement? What's the most tax efficient way to withdraw from different types of accounts?
Absolutely. This is a really great question, Susie, and I think it comes down to client-specific information. So I can say that traditional thinking was to always start with taxable accounts, then tax deferred, and finally tax exempt. However, when you realize that tax bracket management can potentially reduce taxes by spreading them out, you need to look at a client's personal situation. So given how many different scenarios could really vary per person, there is no one right answer to this question. In my practice, I truly take an individualized approach as there is no one size fits all in portfolio strategy. For example, even a client's marital status could impact withdrawal strategies. IRAs and HSAs or health savings accounts have preferential treatment for spouses. Something not a lot of people realize is money left behind in HSAs to non-spouses have to be paid out in 1 year. Clients can then use the year of death to use HSA funds to pay for medical expenses for the decedent, but the remaining balance will be paid out.
All right, thanks, Seema. Julie, we were talking about charitable earlier. So are there charitable strategies that can help with taxes on retirement income?
Well, so yes, there's actually several different ways that you can potentially reduce your taxes on retirement income by gifting to charity. And so the first way is to make what's called a qualified charitable distribution, or QCD for short. So after you reach the age of 70 and a half, you can directly gift from your IRA to certain types of charities, and then that gifted amount's going to be excluded from your taxable income. But there's a couple of things you need to know about QCDs. They can only be made to public charities. They can't be made to private foundations or supporting organizations or to your donor advised fund. And they do count towards your required minimum distributions each year. And in 2025, your QCDs are limited to a total of $108,000. But this amount's indexed with inflation, so just keep an eye out for that amount going up over time. And then last thing to note about QCDs is that they'll help to lower your adjusted gross income. So this, of course, could potentially reduce your Medicare premiums, your taxes on Social Security, and then just your overall taxes. Now, the second way that you could potentially reduce your income is to simply gift your highly appreciated stock to charity instead of giving cash. And so this would obviously reduce your capital gains taxes in the future. And then the third way to potentially reduce your income with charitable gifting is a little bit more complex. You can basically make gifts into an irrevocable charitable trust. And these come in two types. There's what's called a charitable remainder trust, where you or a beneficiary that you choose would receive an income stream for a number of years or for life, and then what's left in the trust at the end of the term or after death, that goes to charity. And then the other type is called a charitable lead trust. And so this is where one or more charities that you choose would receive that income stream for a number of years, or it could be for the lifetime of the person who creates the trust, or for the lifetime of maybe their spouse or maybe a lineal descendant. And then after the term ends, or after the death of the person whose life was used as the measuring life, what's left in the trust goes to you or a beneficiary of your choice. So how charitable trusts help to save on taxes is that if you gift into the trust during your lifetime, then you'll likely receive a partial charitable income tax deduction on your tax return. Or if you go ahead and you set this up, it's created and funded after your death, so it's part of your estate plan, then your estate's going to receive a charitable estate tax reduction. I'm sorry, estate tax deduction. And then the other thing to keep in mind is that gifting into a charitable trust is going to defer capital gains taxes on the gifted assets until distributions are made from the trust to a non-charitable beneficiary. And so that's just a few different ways that you can reduce your income in retirement through gifting to charity.
Appreciate that, Julie. Thank you. Now, staying with retirement for people who may be thinking of moving either before or in retirement, what do they need to know about tax considerations? Bobby, help us here.
Yeah, so I think we're seeing a theme kind of weaving through here around not forgetting some of the state tax implications and considerations when it comes to some of this stuff. So, a lot of folks have been coming to us at or near retirement saying, what am I doing living in the Northeast anymore? Or why don't I go live somewhere warm? Or I have a place in Florida. Why don't I spend more time there? We've seen a lot of mobility over the last few years, and that can certainly complicate folks' state tax footprint. Investment decisions certainly come into play. A lot of Northeast states have increased state level taxes over the past few years. So the state tax burden is playing an even bigger factor in decisions. So I think a few things to keep in mind, Susie. Be very mindful of days spent and any other factors when you're planning out a move. Certainly states can and will ask questions in moves and when folks are filing different state level tax returns. So I think showing intent, i.e., like all the soft things, membership, places of worship, driver's license, voter's registration, etc. Track your time in a calendar app so you can show where you were. States will certainly want to see more time spent in the new location, that you're really putting down roots and kind of planting your flag in that new location. And if you are planning on moving, keep in mind the timing of income events as you're considering that move. So selling a business, securities, deferred comp, the timing on all those things can become really important.
Right, so be mindful of where you are. Appreciate that, Bobby. Let's ping pong it back to you, Julie. Are there any opportunities to use trusts to help manage your taxes?
Yes, absolutely there are. So let's start with the most common type of trust used in estate planning today, which is the revocable living trust. So a revocable living trust is typically created as the foundation of your estate plan and is for incapacity planning and avoiding probate and then keeping your estate plan private. So for income tax purposes, a revocable living trust is what's called a grantor trust, meaning the person who creates the trust, called the grantor, is responsible for paying taxes on the income generated by the trust. So while there won't be any immediate income tax savings by creating a revocable living trust, most assets that are held in the trust at the time of death will receive a full step up in the income tax cost basis. So this will save your heirs on capital gains taxes when they later sell their inherited assets. Now, on the other hand, we have an irrevocable trust, and those can be set up to minimize income taxes, estate taxes, or maybe even both. So irrevocable trust can also be set up as grantor trust for income tax purposes. So the lucky grantor pays the taxes on the income generated by the trust, and then this is going to reduce their estate by simply paying the taxes. But for estate tax purposes, any appreciation of the assets that they've gifted into the trust are going to be removed from their taxable estate. And so just a couple of examples of irrevocable trusts that can be created to reduce estate taxes are the Spousal Lifetime Access Trust, or a SLAT for short. So a SLAT's created by one spouse for the benefit of the other spouse and the ultimate heirs, so spouse and children, grandchildren. And the goal is going to be to remove any appreciation of the assets that are gifted into the SLAT from both spouses' taxable estates. And then we also have what's called a grantor retained annuity trust, or a GRAT for short. So GRATs are created for a limited number of years, and the goal is to pass any of the growth that the assets gifted into the trust experience. Any growth in those assets would be gifted over to the trust beneficiaries. And so then we also have some irrevocable trusts that can be set up as non-grantor trusts for income tax purposes. And the reason for doing this would be to help reduce state income taxes. So with the non-grantor income taxes can be shifted away from the grantor's high income tax state to the trust itself. And so you'd want to, and of course you'd create that trust in a state where the tax laws are a little more favorable. And as I mentioned before, now is a good opportunity to review those existing irrevocable trusts so we can look for any type of estate and income tax planning opportunities that might be available now with these new tax laws.
All right, appreciate it, Julie. I'm hearing slats and grats, so I'm thankful that you're here to help us with trusts. Now, speaking of estate planning, the laws around inherited IRAs have changed fairly recently. Can you speak or can you explain what potential heirs to an IRA need to know?
Yes, so the Secure Act, which was signed into law back in December of 2019 and became effective as of January 1st of 2020. So this new law significantly changed the rules for how assets need to be withdrawn from an inherited IRA. So prior to this, most non-spouse beneficiaries could stretch those required minimum distributions over their own life expectancy, and this was the so-called stretch IRA. But now most non-spouse beneficiaries have to withdraw the IRA assets by December 31st of the 10th year following the original account owner's date of death. But I do want to clarify that after the Secure Act, surviving spouses can still use that life expectancy method to calculate their required minimum distributions. And in addition to surviving spouses, there's a very narrow category of what's referred to as eligible designated beneficiaries who can still use that life expectancy method. But for most non-spouse beneficiaries who inherit traditional IRAs, if the original account owner died before the date that they had to take their first required minimum distribution, then the beneficiary doesn't have to take any required distributions in years 1 to 9, but then they do have to fully withdraw the IRA assets by the end of that 10th year. Now, on the other hand, if the original account owner was already taking required minimum distributions when they passed away, then the beneficiary has to take required minimum distributions in years 1 to 9 after the account owner's death, based on that beneficiary's life expectancy, and then the remaining balance has to be withdrawn by the end of that 10th year. And then for Roth IRAs, the beneficiary doesn't have to take any distributions in years 1 to 9, but they do have to fully withdraw the Roth IRA assets by the end of that 10th year. And so I just want to say, based on those changes, if you haven't taken a look at your IRA beneficiary designations recently, then you really should, because you want to make sure that your IRAs will still pass the way you intend them to.
Yes, can't underscore the importance of having your beneficiaries in place. Thank you for that. All right, let's pivot a bit here. Another area of tax management we want to discuss is around investing. So let's talk about taxes on investment income. Bobby, how can clients reduce those?
Yeah, I think a lot of your, standard blocking and tackling tax planning applies here. So as you're going into year end, think about tax loss considerations to reposition the portfolio. Something to be mindful of is how the netting rules work when we're talking about short-term and long-term gains and capital gain distributions, and how does that all work together? So kind of let's go through those rules quickly. So short-term capital gains and losses are taxed at your ordinary income tax rate. So if you're in the top bracket, that's 37%. On the other hand, you have long-term capital gains and losses that are taxed at your preferential rate. So that's a top tax bracket of 20%. And according to the tax code, you first offset your short-term losses and gains together, and you offset your long-term gains and losses together, and then anything left over, it kind of gets netted together. And so you could find yourself in a situation, that may not be the most tax efficient if you're using something like a short-term capital loss that could provide a benefit at 37% to offset a long-term capital gain that's only taxed at 20%. You're effectively turning something that could be a 37% deduction into a 20% deduction. So we work with our clients a lot on this as we're going into year end and they're managing their portfolio to make sure they're being as tax efficient as possible, with what they're trying to achieve going into year end. So I think very, very important to kind of have that conversation with your tax advisor before you think about any considerations around tax losses. And I think one thing, the flip side of what Seema said earlier and how the wash sale rule doesn't apply in the situation of gains, it does apply in the situation of losses. And so a wash sale is when you sell a security at a loss and you buy back that same or substantially identical security within 30 days. Effectively, the IRS looks at it as you're just in the same situation you were, and you're just taking, accelerating using the loss. So they won't let you use that loss in that instance. So again, very important to just consult your tax advisors. You're thinking through these strategies.
A follow-up question for you here for our clients. What about taxes on mutual fund shares?
Yep. Yeah. So mutual fund, if you're a mutual fund investor, you may have long-term gains, in the form of mutual fund distributions. So I think you want to keep a close eye on your fund's projected distribution dates for capital gains, as you're going through this whole exercise of, do I have losses in the portfolio? Could they offset that? So I think timing something to be very mindful of. Keep in mind that even in years when the value of your fund may decline, a fund manager can realize gains on individual securities, even when the overall basket loses value. Additionally, mutual funds can also distribute short-term capital gains, which are treated as ordinary income for tax purposes. So unlike the short-term capital gains that we talked about from, for instance, selling securities, the investor cannot use capital losses to offset these type of mutual fund short-term ordinary type income. Some mutual funds now will explicitly call out tax efficiency as an objective. And, while they'll not be free from capital gain distributions, they may be more efficient than funds that, for instance, do a lot of trading and do not take the ultimate tax burden kind of into consideration. And some folks may want to look at ETFs as they may offer some more tax efficiency compared to mutual funds.
Speaking of selling stocks, some of our clients have long time holdings that may have appreciated in value. So, what are some strategies to dilute those positions while potentially reducing tax consequences?
Yeah, so we hear this one a lot, and I think the first thing that comes to mind whenever I hear appreciated securities is what's your plan for charitable giving? If that is part of your plan and you are charitably inclined, these can be a very, very good asset to gift to charity. You can donate these shares directly to charity, or as Seema pointed out, to a donor advised fund, and you capture a fair market value deduction for the value, as long as it's held greater than 1 year, while avoiding any tax on the appreciation. Some other strategies may involve gifting some to family members or trust for family members. Now, I think the important thing to remember here is that when you gift appreciated securities or any appreciated property, in that scenario, the family member who receives it would be responsible for paying any capital gains tax on that appreciation when they sell the position. Contrasting that with someone who inherits those shares of stock, right now under the current rules, they receive a step up in basis of those shares, potentially wiping out much, if not all, of the capital gains. So you have to weigh the risk of holding the position to receive the step up of basis at death versus gifting the asset, and having the next generation potentially have to deal with those, future tax obligations. However, could there be an opportunity, where that family member is in a lower tax bracket, so you may be able to achieve some tax efficiency. So I think, Seema brought up a very good point earlier. I think a lot of this stuff is very individualized and case by case and fact determinative. So I think very important to, consult your advisors on this. You could also, always just sell the security and try to offset it with any tax losses available in your portfolio, like we discussed. But again, I think the main takeaway is how does it fit into your overall plan and the goals that you're trying to achieve.
Certainly also underscore the importance of your overall plan and your goals. So what about dividends? Many of our clients hold dividend-paying stocks for income. We received this question from a client. If you have a high dividend strategy, are there still options to reduce your taxes? Seema, can you help us here as you work with clients all the time?
Sure. So, Susie, I think it's important to remember if you're buying dividend stocks in a taxable account, that you can actually receive two different types of dividends: qualified and non-qualified. So qualified dividends are taxed at the capital gains rate, and non-qualified are taxed at ordinary income rates. So if a client needs income and it is a low tax bracket, it can make sense to have high dividend stocks in a taxable account. However, for individuals who have other sources of income, such as pensions, Social Security, annuities, placing the dividend paying stocks in your tax advantage account, like the IRA, could shield the income until you actually need it.
All right, Seema, we have another client question for you. How should assets be balanced across mutual funds, tax managed funds, IRAs, stocks, and bonds to potentially reduce taxes?
Yeah, so I'm actually very passionate about this topic because, as the saying goes, it's not what you make, it's what you keep. And Fidelity does this well by layering asset location on top of asset allocation. So asset allocation is what you own. It's your stocks and your bonds, whereas asset location decides where you put them, your taxable account, tax deferred, or tax exempt. And the goal is making sure you get the right asset in the right location. So for example, in your taxable account, Fidelity will keep most of the assets in individual stocks or municipal bonds or any other tax efficient security. Whereas in the tax deferred IRA, we put inefficient assets like your bonds, REITs, and dividend paying stocks. And in the tax exempt account, we put our growth, international, and small caps. Fidelity will then rebalance the total asset allocation in tax deferred accounts without having to make many tax changes at all in the taxable account. This actually helps reduce the client's tax burden. In addition to that, as Bobby mentioned, in taxable accounts, we try to tax loss harvest throughout the year. So a taxpayer can use that $3,000 of capital losses to offset ordinary income per year and carry forward any unused losses into the future. Let me give you a really quick example of a client who is paying the IRS on capital distributions and gains from mutual funds held in his taxable account, but not using the income. We integrated asset location, and in the first year, he was able to save $15,000. Consider the potential impact over the 30 years of his retirement.
Great example there. Thank you. Seema, let's tie this all together. So, how do you help clients incorporate tax planning into their wealth strategy? What do they need to keep in mind or be aware of?
Yes, so we will work closely with our clients' tax advisors and help clients build out different buckets of money that they can tap into and pivot if their situation changes. This is called tax diversification planning. I think often we can get caught up deferring a significant portion of our income into our 401ks early in our careers. But the earlier we can start diversifying into other accounts like our HSAs, our Roth, and taxable accounts, the easier it would be to pivot in retirement. It's also really important to tie tax planning back to the client situation. So if a client has a legacy goal, the withdrawal strategy may significantly differ from a client who wants to leave almost $0 in their portfolio at the time of death. I mentioned this before, but just to recap again, a client's marital status will also impact the withdrawal strategies. So remember, IRAs and HSAs get preferential treatment when you leave them to a spouse versus the non-spouse inheritors. So when I sit down with a client, I'm taking the whole picture into mind without defaulting to some prescribed tax methodology that may not fit their personal situation. I actually had a recent client who spent most of their taxable assets very early on in retirement. And now they realize that all the money that comes out of their IRA will be taxed as ordinary income. So if there's any expenses that exceed their normal spending, it could potentially push up their tax bracket as well as their IRMA premiums. So just to remind you, tax rates are marginal. So not all taxes are taxed in one bracket, whereas Medicare premiums are on a cliff schedule. So even $1 over a certain income threshold can push a Medicare premium up by over $100 a month per person.
Thank you, Seema. And to our panelists, you've given our viewers so much to think about. So before we sign off, I'd like each of you to share a few key takeaways. Julie, let's start with you.
Sure. So even with the higher federal exemption, estate planning is going to remain important for non-tax reasons. So for incapacity planning, making sure your assets go to your intended beneficiaries, reducing the likelihood of family disputes and litigation, avoiding probate, and then minimizing death taxes at the state level. And then with all of these changes in the tax laws in recent years, if you already have an estate plan, and it hasn't been reviewed in the past, say, 4 or 5 years, then you really need to dust it off and make sure it still works the way you want it to work. And it also incorporates tax planning based on the newer laws. And then last but not least, unfortunately, when it comes to tax laws, permanent really doesn't mean permanent.
Bobby.
Yeah, I like that, Julie. I mean, over the last 10 plus years, we've seen changes in the tax law at, I think, a pace at which we had not seen before. And I don't think we'll see that pace slow down. So from my perspective, I think the big takeaway is now is a great time to connect with your tax advisor. The recent legislation provides folks, a great opportunity to reevaluate their financial plan and see how some of the things we talked about today fits into that. And, if there are ways to optimize their overall tax situation.
And Seema.
Yeah, so I think Roth conversions often receive a lot of attention, but coupling them with asset location and tax bracket management could potentially help reduce taxes over a client's lifetime. And the other thing I would have people keep in mind is think long-term tax planning versus minimizing taxes in 1 year. It really is a long game.
All right, well, thank you, panelists. And if you have more questions about tax strategies in your financial plan, please reach out to your Fidelity representative. If you don't have a representative, visit fidelity.com/find an advisor. And for more timely updates and insights on other financial planning topics, subscribe to Insights from Fidelity Wealth Management for exclusive invitations to future wealth management webinars and access to our weekly newsletter. So thanks again for joining us.